So I make $122,000 a month profit on this project right here. Come on in, I'm gonna show you how I did it. So Ross and I bought the land on this project and we built 202 units, primarily because the growth of Phoenix was heading north up the interstate towards Sedona and Flagstaff. And we wanted to capture that growth. And of course we did, because lots of employment is moving out into this area, most notably the TMC plant, which is the Taiwanese manufacturing chip plant. It's a $40 billion project, which is just, what, a couple miles from here. So that's going to employ a lot of people. It's under construction right now. But without people, real estate doesn't work. So we bought the land in about 2015. We ended up starting construction in 2016, and then it was fully complete in 2018. Then we did a cash out refinance in 2019. So we've owned it for about 10 years, but it wasn't in service till about 7 years ago. So before we go over the numbers, because those are really important to understand the economics of the deal, it's most important to understand how the thing is run, because obviously without great staff and great ownership and great partners, then it's not going to produce.
All right, so first we're going to start off at our clubhouse right here. This is just open during our business hours. We're open Monday through Saturday, 10 a.m. to 6 p.m. So this is our pool area. We have a couple of different things in here. Obviously, our main one is the pool, but we also have a fire pit, a barbecue station, as well as our hot tub.
This area is jamming on the weekends, right?
Yes, it is.
You're not going to seat here, right? And the people are barbecuing. They're hanging out by the fire pit, obviously using the pool, but this is obviously one of the bigger social spots for people to come on the weekends.
Mm-hmm.
The whole goal at all times is to keep the occupancy high and the vacancy low and the delinquency low and the expenses low. That's the goal. That's what we're trying to do to maximize the return for the investor. Everyone has to have kind of their daily to-do list, whatever that is. So in the mornings, the teams get together, even if it's for 10 or 15 minutes, decide, okay, this is what's important today.
Mm-hmm.
And that might be move-ins, that might be maintenance requests, that might be little special projects. You never know, right? And sometimes we have units maybe that are sitting on the market for, let's say, more than a week or two. That might be the focus of the rental. And then, of course, the staff's job here in the office is getting traffic in here as well, right?
Yeah.
So as people drive by, or the marketing, working with the corporate office to try to figure out the best marketing so that the traffic is coming in here. And especially now, because with AI and GPT and the chat, you can actually guide somebody all the way to the appointment level. And then it's a matter of them coming and then walking through and hopefully renting. So Ross and I bought the land and then built this whole project, right? So we were the developer and the general contractor. In other words, we hired all the subs and we ended up building the project. So we were able to phase it for leasing as well. So what happens is it takes about a year to deliver the clubhouse. And then after that, you deliver 20 to 30 units a month. So this property has 202 units. So it takes about another 10 months to deliver the rest of the project. So from beginning to end, a project like this might be about 2 years. And the lease up is about 1 year. So typically when you get the clubhouse, you start leasing. You pre-lease too, but then you start moving people in. And of course, it's a race against the clock because you're trying to pay off that construction loan and get a permanent loan on there. But you can't do any of that until the property is stabilized, which means that it's fully occupied. We're 97% occupied. So what that means is that's about 6 units vacant out of about 202 units is all right now. So when you get to that point, then you can start actually keeping up with the market rents too. When you're at 97% occupied, what oftentimes that means is that there's a lot of demand for a property like this right now. This is a split 2-bedroom.
Yes.
Yeah, so what you do, there's a couple different 2-bedroom configurations. You can actually design those because we built the project. A lot of times you'll see the hallways that go down. You have 1-bedroom, 2-bedroom, 3-bedroom, let's say. This would be like a split bedroom. So you'd almost have like 2 masters so that you could have 2 adults here, let's say, to split the rent, or it could be for families. But It's a better layout than, of course, the long hall where they're just next to each other. And then, of course, the whole apartment revolves around the kitchen. You try to keep the kitchen in the center of the unit, so because everything kind of revolves around there, and you can see you've got access in and out from both sides of the kitchen, which is really, really important. Because a lot of times you won't see that. And so the reason you furnish it is because what people do is when they walk in, they always look at their own stuff. They're envisioning their own stuff. Does my stuff fit in here? My dining, my couch, my TV, all that kind of stuff is important so when you have it furnished like this, they can come in and kind of see it with their own mind of exactly how their stuff might fit in here. And it's how many square feet?
1,097.
Yeah. So this is just about 1,100 square feet, and it rents for about $1,800. So call it $1.80 per square. So that's kind of how you take a look at stuff. So we should probably this time next year be closer to $2 a foot. So I would imagine this is probably going to be $1,800, $1,900 pretty soon, based on our occupancy, which is at 97% today.
Yes.
So as I said before, Ross and I bought the property in 2014. By the time we got it entitled and ready to go, it was about 2016. So then we broke ground on the 202 units after we designed it and raised all the money. So here are the high-level numbers. As you can see, the full value of the project with both construction debt and equity was $30,650,000. That's what we thought it was going to take. So first we went to the bank and we got a $21,455,000 construction loan, which at the time was 70% of cost. Now, construction debt is a lot different today, but of course, this is going back to 2016, 2017. And then we knew that we needed to raise about $8,250,000 in order to complete the project. And that, of course, would have got us both the construction loan and the equity for a total of $30,650,000. We also knew that it was going to take 2 years to build the project and about a year to lease it up. But at the end of the project, we estimated, based on the rents and the expenses at the time, that we thought that the property was going to be worth about $40,250,000. So this is precisely how you raise money. So the value add for this construction project was $9.6 million. Of course, the risk was the construction itself, the interest rates, and all the things that can happen like we just witnessed during the pandemic. So before we broke ground, we knew how much it was going to cost. It was going to cost a little over $30 million, but we believed that it would be worth a little over $40 million. And that's based just on the math itself. That's based on the rents minus the expenses. From the time we bought the land to the time we actually stabilized was about 4 years, but the time we broke ground was about 2 years. So from the time we broke ground on the property till the time that we stabilized the property, which means that we were at 95% or more, we were able to take those numbers to the bank and get what's called permanent financing. So the permanent financing removes the construction financing. So you start a project with construction debt. Construction debt is typically higher priced because the bank doesn't have any collateral. They literally have the land and some idea. So they're financing me and Ross. So Ross and I have to sign personally as a personal guarantor on the construction loan. So we are very motivated to try to get this property built and put permanent financing on, because once we get permanent financing on a project like this, then that removes the personal guarantees that it took for Ross and I to be able to build the project from the very beginning. As you're designing a property and you're trying to take a look at, to maximize the amount of units on there, you take a look at things like that. You can imagine there's a major road out here called North Valley Parkway. So what you do here is you can actually put in garages. So you can see we put these 6 garages in, and we have them around the properties because sometimes these would be the harder units to rent. So what you do is you put garages here, and then you put a couple of units above them, and they're called carriage units. So those are actually like 1 bedrooms with studios typically, but they're in high demand because there's nobody on the left or right and nobody below them. They're individual units, but they're over garages. So it solves 2 things. One, the residents now have a place to park their garages or even store stuff if they want. And of course, we're getting premium units. We're getting premium prices for the units above the garages as well. To buy land, develop it, find a contractor, build it, to the price that you say and get all the financing, all that kind of stuff. Most syndicators wouldn't even attempt this. So we have a staff here, what, 6?
We have 5. So I am the property director here, and I have an amazing assistant leasing manager. And then we also have 1 other leaser, and we have 2 maintenance staff. So we have 1 supervisor and 1 technician, and that's all it takes to run this place.
So the best thing about this property is it comes with its own zip line. So what we decided to do about 10 years ago, because people love their pets, and we decided to embrace them. And so at every property that we have, we put pet parks in. So this is one of the many that we have. And what we found is that a lot of people say no pets. You know, hotels say that, a lot of apartments say that, because they don't want them tearing up the property and, of course, the individual units. So we decided to embrace it. And we actually won an award by the Humane Society as one of the top companies in the country to embrace pets. And so we have bowls and leashes and collars and all that stuff in the clubhouse for people to use. And then we encourage pets, and then they get these areas to use. A lot of seniors have pets. So, you know, a lot of young people may or may not, but a lot of seniors have pets. So if you look at the numbers, so seniors oftentimes are really good renters, right? Because you don't really have a lot of the issues that you would maybe if they're younger. Not to say that there are, but what we found is when we embraced pets, we got an older population, because a lot of people that are responsible pet owners are oftentimes older. So that's why we put these in. And that just helps occupancy, helps revenue, helps all those kinds of things. So fast forward from 2019 for the cash out refi. This property is now worth about $52 million. And that's simply 5% capitalization rate based on the current NOI, or net operating income, from the trailing 12 months financials. That's all it is. So that equates to about $52 million that this property is worth today. So we built it for 30. It was worth about 40 when we finished, and today it's worth about 52 million. The important thing to understand is when you do a cash out refinance, that money was returned to the investors tax-free. It's very important to understand that, because it's just a return of capital. The current loan on this property is right around $25 million. So you can see in today's value, this property has about $27 million worth of equity. If we were to sell the property today, that's very close to what this property would net if we decided to sell it. It would be the value of $52 million minus the debt, which would equal the amount of net cash. So we're not going to sell this property, because each and every year it produces about $1.5 million in profit, which is why at the beginning of this video I was telling you that's right around $120 to $125 per month in net cash flow. That's after all bills are paid, and that's after mortgages paid. So why would you sell something that's producing $1.5 million annually just to get it to $27 million? Well, what you would do is you would perhaps do another cash out refinance when rates come down and scoop some more of that equity, but you never sell an asset that's producing this kind of cash flow. What are you going to do once you sell that? What would we do with the $27 million? There's no place to invest it right now. The best place to invest it is right here. So that's why we keep it here, and we take advantage of all the tax benefits that you get, like bonus depreciation, cost segregation, and regular depreciation. Because a lot of that cash flow is tax deferred as a result of depreciation. The investors would not be happy if we sold it, because they'd be walking away from all this monthly profit just to get the $27 million. So this is precisely the difference between Ross and I over many of the syndicators out there today. A lot of the time, syndicators will buy something, and then they'll improve the value, and then they'll sell it. What happens, however, is that they have lots of tax consequences, and of course, they want to go out and do it again, and they're not always going to time the market, just like we're seeing today. So on this property, we've owned for almost 10 years when you look back at when we actually acquired the land. And we're just going to continue to harvest this property and continue to do cash out refis when rates go down again, we'll scoop some of that 27 million, maybe 8 or 10 million of it, and we'll distribute it out to the investors, again, tax-free, because you don't pay tax on debt. Now, it will definitely increase the mortgage payment. It'll increase the debt more than likely. So the cash flow will go down, but we're distributing $8 to $10 million tax-free to all our investors. So obviously the investors that invested in a project like this, there are risks. There are construction risks and all kinds of other things. This is how you build great relationships with your investors, by actually showing them the money. So if you're a business owner and you're working 12 plus hours a day, I understand, but there's a better way. If you want to see how I broke free from working over 12 hours a day, from growing a small company to a very large company, take a look at my video here.